So today I'm going to do the UK stocks I'm buying December 2024. So this is the series I do on the YouTube channel, probably my most popular video series that I do on the YouTube channel, where I go through all the stocks that I'm buying and selling, and I did all these moves between the 1st of November to the 1st of December. So I do this series so you guys can track along with what stocks I bought and sold, because any moves that I've made are on this video series, and I do it every month for you guys, so you can actually see what stocks have worked out, what stocks haven't worked out. It keeps up the transparency, and you guys seem to enjoy these video series. So I'll try to spend a minute or two on every stock. There's quite a few on this list today because we did have, well, it came off the back of the awful budget, and that led a lot of UK stocks to absolutely tank from the budget. So I was quite actively buying a few UK stocks out there, so there's quite a few on this list. I'll probably try to spend like 3 or 4 minutes on each stock, but if you want a bit more information on that stock, I have more of a deeper dive on the YouTube channel on most of these stocks that are like 10-20 minutes long, so you can get a bit more detail. So yeah, hope you enjoyed it, guys, and let's get started. Now, just before we start, if you do want to join the Patreon and support the YouTube channel, £5 a month, link is in the description. You get 2 exclusive videos a week on there, and you get to know what I'm buying and selling on real time on there. And as well, that there's a Discord you join, which will give you access to talk to me and also other members of the JKR community, around 500 of us, to talk to or talk about stocks daily on there as well. So if you do want to join, links in the description, £5 a month, guys. It will be going up in January, so take advantage of it while it is at the current price. And as well as that, if you do want to start investing and use the platform that I use, join Trading 2 with a link in the description, and you get a free share worth up to £100 or free fractional shares worth up to £100 when you join through that link in the description. Let's get started. So first one, JD Sports, the one stock on this list that has made me go, what the what's the next bit is going on with this stock? I generally don't know. I am very surprised to see JD Sports falling as much as it has been falling. It looked like everything was going well. It looked like it was having a nice rally up towards September, and then it just kind of started falling down. I don't know if that was uncertainty around the elections, fear building in around the budget, and then we did get the budget, and then it absolutely tanked after the budget. And then there was also a little bit of a trading update in there that the market did not seem to like. I thought it was okay. The market seemed to not like it, and I can't believe how much it has dropped since that update. Now, JD Sports, a lot of you guys will know in the UK as a UK retailer, a retailer of brands like Nike and Adidas that is very popular. If you ever go into a JD Sports, whether it be the Trafford Centre, the Arndale Centre, you'll know it's very busy. But that's actually not where the growth driver is. The growth driver for JD Sports is they're currently expanding into Europe, and they're currently expanding into US, and that's currently where the big growth is. And with the likes of the acquisition of Hibbett they've recently made, that is the growth driver for them. Now, like I said, I think it's just dropping because there's fear around the budget, the increase of the national insurance payments, and because they have a lot of staff, I think people are a little bit worried about where JD Sports is going. I think personally they'll be able to pass those prices on to the consumer, which is a little bit worrying for the inflation next year, as I think a few businesses will try that. But I think JD Sports has the pricing power to do that, because, you know, imagine sometimes some of these coats and shoes that they're selling at, you know, £100 worth of shoes. You start adding a couple of pounds worth of shoe or every kind of coat, I think they'll probably be able to get away with it. Now, like I said as well, I thought the recent update was good. The market didn't like it. It sent it down. They came out with organic sales growth of 5.4%. And like-for-like sales was down 0.3%, which you probably want to see a little bit stronger. But for the full year, it's still up. They said that basically what happened in this quarter is the uncertainty around the budget and the election has slowed things down a little bit, which was kind of always the kind of concern potentially that could happen, but nothing too major. They basically said what's going to happen is we're going to come at the lower end of our guidance. For some reason, the market took it as a major profit warning, sold it off massively, and it just didn't make sense, because even though it was at the lower end of the guidance, we're talking about where JD Sports is still going to be somewhere around like a 7 times forward earnings. You shouldn't be getting JD Sports for a 7 times forward earnings. You look at the previous execution of this company and how well they have executed during that time frame, and really since 2020, the company's gone from around about 6 billion worth of revenue up to around about 10 billion of revenue. From a profit point of view, they've gone from about 252 to 342, but they're about to close the year off on a lot more profitability than that. They're actually going to close off in January around about 440 million in profitability, so nearly doubled. And as we see the revenue continue to grow at good rates, analysts are currently forecasting just short of double-digit growth. and also profits go up to 721 million as well. And as well as that, another big increase in 2027. This company just continues to keep doing what they do like they've done previously, which is expanding to Europe and into the US, and it's growing revenue and profit at really good rates. That does also lead them to have a pretty decent balance sheet, as you can see here. A little bit of debt on the recent acquisition, but as you can see, the debt is around about 905 million, with a profit they're going to be forecast to do. That's nearly a year's profit. That's quite easy for them to pay off as well, and they do have the cash if they wanted to pay it off overnight as well, which is a great option for them to have. Insider front as well, there's been quite a few insider buys as well going on inside the business, which you want to see when the stock is at these kind of levels, from the likes of the CEO, for example, and the chairman. That was around about £1 and 8 pence and £1 and 9 pence. And if we look at the stock right now, it's actually lower than where the insiders bought the stock from. And you're looking at a stock that's kind of gone back down to levels of where, we were at those like Liz Trust kind of levels. Not as low, but nearly as low as that. And just a little bit higher than where it was during the COVID times. And you look at the stock's historic performance and you think it just doesn't make sense while it's here. I think the stock should be a lot higher than where it is right now. And I really like JD Sports. So I am buying that one, and I'm actively buying that one as well. Currently in the most recent week as well. Cake Box. So Cake Box as well. I did buy a little bit of Cake Box. I've got to say, since I did buy a little bit of Cake Box, the stock has rallied up a little bit since then. So it's been on a bit of a bounce up, as you can see here. So just bear that in mind. I looked at the stock. They basically came out with a trading update, and it was really strong. The stock basically did nothing. I thought, okay, I'm going to buy on this trading update, and then the next day the stock actually ended up going up. So it's okay valuation right now. I personally wouldn't be out. If I was to be a buyer, I'd be buying it a little bit cheaper than where it is right now. So maybe this one's a little bit too late, I would say, because it's around about 16 times earnings, 14 forward times earnings. But when I was buying it, it was a little bit cheaper than that. You still get nearly 5% dividend yield though, which is really good. I don't know if any of you guys have ever been to Cake Box, but the cakes, in my opinion, are the best cakes around. I would say that after you watch this video, go try one, see if there's one in your local area. And that's the thing, is like there's still a lot of expansion for them in the UK. There's still a lot of times I look at them and I think, how's there not a Cake Box here? I was at Meadowhall in Sheffield today, and I was walking around and I was thinking, how's there not one in here? Because the one I normally go to is in like the Arndale in Manchester, and the amount of times I go through the Arndale and I'm buying like a slice of cake when I'm there, and I'll have it when I get home. I was thinking I'll do the exact same here in Meadowhall, and it wasn't one here. I think there's so much potential for them to expand into, and like I said, whenever I go to the pop-up shops in the Arndale Centre, there's always a big queue for them. And as well as that, they've recently launched their loyalty program as well, which obviously is the Cake Club, which I think is a great addition as well for them at the moment. Recent earnings were great, revenue were 4.3%. But what was even better is the scale now. The scale that they're ramping up to, and you can see the profit is actually now growing faster than the revenues, which is what you want to see. Increase of the dividend as well by 17%. Cash at the bank would have gone up if they didn't buy a new factory, which I think is fair that they're investing back into a business as well. What was more exciting is their comments around the future of the company. They basically said that it has continued to do positively, and they said that actually total franchise sales was up 9.9% in October 2024, which is great because this is actually showing that they're scaling up towards the back end of the year. So yeah, it looks really good that even the sales are doing even better towards the end of the year, and they've just executed so well. Past performance, great revenue growth, great profit growth, really good profit margins, 12% profit margins as well. Insider front, not so long ago there was the CEO and founder, he bought a ton of shares at £1.74, which, like I said, isn't a million miles away from where the actual share price is right now. So yeah, I think this was a good buy, but unfortunately I think by the time I mentioned it on this video, I think it has run up a little bit from where I did buy. So hey, I guess that's why you got to be on the Patreon, I guess. The one that I've been quite aggressively on at the moment is B&M. I've been quite aggressive buying at B&M during the last month, and this one's actually gone a little bit more down in the last month than up, to be fair, compared to something like a K-Box. 11 times earnings, 4% dividend yield. Now the dividend yield's actually quite interesting because if they do a special, I don't know what B&M are going to do. Sometimes they do a special dividend. Sometimes they do. They've been hinting at a share buyback. So it depends if they do a share buyback or if they do a special dividend. Because if they do what they've done historically with like a special dividend, the dividend yield on this is actually like could be somewhere between like 7 and 10%. So just bear that in mind, that it could even be a better dividend than what is showing here. Same again, this stock is just so low. You know, it's fallen back to where we were at in the Liz Truss period, back at the COVID times, and you think about the fear that was around then, and the stock has fallen to those sort of levels. Not that that's an indicator that it's a good value, but it just kind of shows you how much it's fallen. Although I do think it's good value, and I'll show you in a second that it's 11 times earnings, and it normally trades around about 18 times earnings. But there's also a few other things, but I'll show you that one in a second. So also, I'll point out that there's also been some insider buying. That's been one of my biggest criticism of B&M recently, is that there's not been much insider buying. But I can cross that one off now because there has been some insider buying, which is good to see. So they came out with a Q1, which are their interim results, which was a little bit weak. Basically, the growth was a little bit slow. I mean, they've got B&M France, which is one of the growth drivers for them. That's been doing really well. But B&M UK was a little bit weak, and I think a few investors kind of got spooked at the start of the year because of that. And you can see the sell-off at the start of the year. And then what I think happened is basically we had the fears around the budget and the minimum wages, and then that sent it even lower. In my opinion, too low now. Since then, we have had an update come out with B&M. Basically, a big improvement has been shown in the recent update, and you can see here that B&M UK has started to speed up again with 3.7% growth as well, which is really good to see. And obviously that's going into their key period as well of the Q4 season, where it's the Christmas season as well, and hopefully as well the growth there does start really kicking in, especially with the new store openings as well. And historically, this company has historically performed very well, as you can see here. If we go on the past performance as well since the CV times, company's gone from about 3.8 billion in revenue up to 5.5 billion. From a profit point of view, 203 million up to 326 million. With nearly 6% profit margins. This is a very high profitable business for this sort of space. You compare that to someone like a Tesco and anyone in that kind of space, you know, normally their profit margins are like 1%. This is quite a high profit margin business as well, which is great. If we look at the current numbers, they're actually about 9 times forward earnings at the moment. What I also like about B&M is that if we're in a good environment, B&M should do quite well. People will go out and spend more at B&M, and if we're in a bit of a weaker environment, well, guess what? People that normally go spending like Marks and Spencer's or somewhere else like that, they're going to be going, oh, I want to watch the pounds a little bit more. I'm going to go to somewhere like a B&M, and that's exactly what happened in 2022. So either way, whatever environment B&M goes into, I think they'll actually be okay. And the great thing about B&M is it's actually quite a light stock. You know, people actually make videos. Like B&M don't do advertising. Most of their advertising comes from like people posting content. Like if you ever go on to like TikTok, for example, or YouTube, there's actually people that like post about going to B&M and saying what they bought, and this is what's currently like the amazing trend at the moment at B&M. And you know, some of these videos here, you know, you get 18k views. This one here, 7.6k views. I mean, this was only like 11 hours ago. This one, 19k views about 1 day ago. This one here, I had to have 108k views. Not that this one's actually too much about B&M. That's just saying how cheap it is, I think, and how how you can survive on £10. This one here, Christmas ones, 30k on this one. Yeah, you know, people like watching these sort of videos. I don't know either. Well, you know, some of these people who watch these videos would probably turn around to us and say, "Why are you watching videos talking about stocks?" But shows you the free advertising, and that people do like B&M out there. So yeah, I like B&M. Next one, Card Factory. No surprise, is it? Card Factory is going to be on the list. Yeah, I bought some Card Factory because the stock fall off was absolutely ridiculous. I bought some shares. It has been rolling up, so I probably won't buy any more Card Factory going forward, but I was buying the dip very heavy during the last kind of few weeks. The stock fell down to like 6 times earnings or something. The dividend yield was over 6%. It shouldn't have happened. Card Factory, obviously you guys know from the UK High Street, retailer of the cards and gifts and presents, moving a little bit more into the gift market. Every time you go into a Card Factory now, you might notice there's a lot more gifts in there, and that's one thing that they are focusing on. Also partnerships, they're expanding as well with partnerships with like the likes of Aldi, for example, partnerships in, I think it's Abu Dhabi, I think it is. the reject store, and also the expansion as a wholesaler in the US as well now. Basically, the market got spooked last time they reported. They came out with their results on the 24th of September. They said that full year is unchanged, but people looked at the number here where they saw profit before tax down 43%, and they panicked, even though Card Factory said this is going to happen. What they're going to do now is they're going to try and balance the profit up to the revenue, because they need to pass on a few costs. They've done a lot of investing, and they feel like that when they get into the peak Christmas period and the scale of volume that they sell during the Christmas period will drag that profitability up, and they will be able to hit the full year guidance. And last week we actually saw Card Factory, and they did an update about the acquisition they made into the US, and also said we're still on track for a full year, and that said the stock to bounce up. And if they do hit their full year numbers, which I thought I had up somewhere, which I don't. Currently at a forward P of 6 still, I actually can't believe that. But if they do hit the full year numbers, this company shouldn't be 6 times earnings. And yeah, I think that if they hit the full year numbers, which we'll find out in about 2 months time, then the stock will majorly bounce, and people that sold off during that time frame will look very silly that sold it off as well. And I think there's also been some insider buying as well going on. Yeah, there's been the lead director that bought, and also the CFO bought some shares on the 24th of June, and the CEO bought some on the 3rd of June. And actually, it's not on Simple Wall Street, but the CFO just bought another 20k worth of shares on Friday, I believe it was. So if you thought that are they going to get anywhere near the full year guidance, well, I tell you, I think if the CFO is buying some shares and they have the best insight out of us all, I think that says a lot. Warpaint. So I have been actually buying some Warpaint. The stock hasn't really done much recently. In fact, it's actually been going down a little bit at the moment. And I'm not really sure why. Once again, you know, Card Factory, I put it down to like they have quite a high set of employers, so maybe there's the fear around the NI costs. Warpaint, not really. I think they've got really only not many members of staff that actually work for them. They outsource a lot of the production themselves, so they don't have to handle it, so they don't have high amounts of employees, so keeps the cost down pretty much for them. So I have no idea why it's kind of really falling at the moment. Same again, these guys actually bought a brand last week as well, and they did a bit of a trading update saying it is in line so far this year. I personally think they're going to be ahead of expectations. Basically, it's been a UK makeup brand that has done very well, growing at very good rates, and also in Europe, growing 38%. US sales did slip a little bit in the first half. Well, I say slip, they grew 10%. That's been a little bit slower than normal. Basically, they had a little bit of a change of plan where they decided to go for the higher retailers, or not going for as many discount sellers in the US. So basically, it slowed the growth down a little bit during this time period. However, what will happen is when they get the new contracts in place, they'll actually have growth again, but also be higher margin growth. So they'll be making more profit than what they previously did. And I think somewhere in the trading update, which I'm going to quickly scan for while I'm talking to you guys here. Here we go, I found it. Current trading update. They now have the US growth of 20%. So this is rebounded from the first half of 11% up to 20%. And obviously this is higher margin as well now. And as well as that, we're going to head into the Q3, Q4 season, which you know, is the fastest part of the time as well, isn't it, for sales? So that's going to be very good for them. So they're going to make more profitability, more revenue growth as well. The US is the big driver for them. You know, they've been very successful in the UK, but if they go into the US from what was the UK of like a 3 billion industry to like a 30 billion, or in the US is it? It could be very good for them, and you can see here really good revenue growth, and as well as that profit is going to move up a lot faster than what people are expecting as well, because of the more higher gross margin business that they'll have as well, and also a cracking balance sheet as well on that company. And the next one and the last one is Money Group. So I've been buying a bit of Money Group at the moment. 14 times earnings, it's on a forward P, I think it's about 11, 6% dividend yield as well. So even if the stock doesn't do anything, I still get a pretty nice dividend from the stock. Had a really tough time at the moment, as you can see here. Another stock that's been impacted and down at the kind of the Liz Trust lows. Comparison site, so you go on here, you compare between motor insurance, your car insurance, travel insurance, and that normally helps them, because if a part of the business doesn't do well, the other parts of the business make up for it. And that's been the case for the last kind of few years. And recently, the insurance business has been on fire and has really helped them. But that's starting to slow down a little bit now as we are overlapping the higher insurance comps. The next two growth drivers for them are going to be the home services. So we need the energy market to come back. So they used to do a big comparison on the energy market. However, because of the energy price caps that's been going on, we basically haven't had that since before 2021. That's one thing that needs to come back, and we thought it'd be done by now, and it still hasn't. The other thing will be if the inflation drops and interest rates drop, and we start seeing like mortgages, competitive mortgages start coming back. The only issue with that is that because of the current government we have and their plan to increase wages and high costs, it's probably going to push inflation up, and there isn't going to be the interest rate cuts. So if anything, I'm a little bit less bullish on Money Group in the last month because of what's currently going on with the current government. So I'll make you aware of that. There was two key drivers: the lower interest rates and the energy market coming back. I thought the energy market would come back by now, and it hasn't. The next time it should come back is Easter, and the other one was the interest rates, and I think we've kind of lost that one now because of the current government. So I will make you aware of that one, that I am slightly less bullish on this one than what I have been in the last few months. But still, even if it doesn't come back, I'm still going to sit on a 6% dividend yield here, and hopefully they'll still be able to drag up the profitability and revenue. Analysts are forecasting still decent drag up in revenue and profitability. 11 times earnings, that's still quite historically cheap to what it normally is, which is around about 18 times earnings. Looking at the company as well, it's got a pretty decent balance sheet if you look here. A little bit of debt on there, but pretty decent debt to equity, and a nice little cash pile there. And as well as that, there has been some insiders buying. If you actually look on the 15th of November as well, there was a buy by the CEO. The only little thing that I'll kind of pull him up on is that he bought, but it was only 10k worth of shares. You got to remember as well, like I think I'll be able to find his salary very quickly. So yeah, he's on what's the total salary? 615k. So yeah, it's not major amounts compared to his salary. You're talking maybe a week worth of work there. That's my only little criticism of it, but hey, at least there's some form of buying, I guess. And yeah, that's it. That's the last stock that I bought. Selling wise, I did sell one stock, so I did call it quits on ASOS. I sold this for, I cannot remember, it was either a high 60, low 70% loss. I just decided to call it quits with this one. I think that there's just a lot of competition out there with the Sheins, the Temus of the world out there, obviously struggling in general, a lot more options, and I just looked at it and I thought, I could carry on holding this, but realistically, the balance sheet's a bit of a mess now. I mean, can I go on the balance sheet? Let's have a look. Yeah, the balance sheet's a bit of a mess now. It just keeps getting worse and worse, as you can see here. Not awful, but it's not, they still sit on 391 million of cash, but it's definitely not great. Not compared to like 2021 where there was like no debt on the balance sheet. And if you look at the forecast at the moment, they're still expected to lose money next year. They're still expected to lose money in 2026. They're still expected to lose money in 2027. I just thought, 3 years that I'm going to have to even wait before they even get break even here. And that's just no guarantee. You can't really forecast that much 3 years down the line. And I thought, there's so many opportunities out there in the UK market now. Why keep the money tied up? If I go put it into what money's left in something like Card Factory or B&M, and they end up doing 100% return, which we've seen already Card Factory do for us 3 times before. If Card Factory goes on to return 100% for us, I nearly make my loss up in that situation. So what's the point of just praying that it's going to work out in ASOS, or actually do something about it? And something like a Card Factory that has been a successful stock for me 3 times before, is entered the 100% return club 3 times before, I'd be a lot better back in that one to try and make the money up from ASOS, and I just thought, I think that's the right move to do. So that's what I did. I just moved it into some other stocks that hopefully will perform better during that time frame, and will help me make up for some of that loss in ASOS. So that's the one that I did sell. So that's the list today, guys. I hope you enjoyed the video as well, and hopefully I didn't natter on too much. Like I said, I've got more of a detailed video on some of these stocks on the YouTube channel, unless there's a particular one you'd like me to do a big update on more recently, that's not just like a 3 or 4 minute quick scan. You know, I'm talking about a good 15-20 minutes with also some numbers run for you guys, where I show you some numbers that they could potentially do in the next kind of 5 years, and you know, let me know as well if that's something that you're interested in. Apart from that, guys, thanks for watching. See you in a bit.